Welcome to our HDIN Research Briefing. Today we're diving deep into the strategic transformation of Idemitsu Kosan. We're going to explore how this old-school energy giant is trying to pivot from its fossil fuel past to fund a marathon toward a greener future. So let's just cut to the chase. How does an oil giant, a company built on fossil fuels, actually survive a green revolution? I mean, this is the multi-billion-dollar question, isn't it? Idemitsu is at this massive turning point, and how they answer this will define everything for them. All right, let's set the stage here. To really get what Idemitsu is trying to do, you first have to understand the incredible pressure they're under. The need for change isn't just a good idea for them, it's literally a matter of survival. And this number, well, it says it all, really. More than 90%. Think about that. Over 90% of Idemitsu's revenue is still chained to fossil fuels. That kind of dependency is a massive, massive risk as the entire world shifts to decarbonize. And you can see that dependency is already hitting their bottom line right here. Take a look at the return on equity. It's been more than cut in half in just 1 year. And this isn't because they're suddenly inefficient. No, our analysis shows this is a direct result of their profit margins getting squeezed hard in those traditional fossil fuel markets. So what's their move? Well, management has kicked off a pretty bold pivot. We see it as a classic playbook strategy, really, using your old, reliable cash cow to fund a brand new growth engine. It's a game plan for any legacy company that's aiming for a radical reinvention. It's basically a two-step plan. On one hand, they're consolidating their old refining assets to squeeze every last drop of profit out of them. That's the cash cow part. And then they're taking all that cash and aggressively pouring it into the future. And make no mistake, they are putting some serious money where their mouth is. We're talking about a committed spend of 800 billion yen. To put that in perspective, that's well over $5 billion US. All of it earmarked specifically for this new carbon neutral strategy. Okay, so you've got this huge pile of cash ready to go. The big question then is, where's it all going? Let's take a look at the businesses they are actually betting on to one day replace oil. Idemitsu has basically placed 4 big bets. You've got these lower carbon fuels like blue ammonia and e-methanol, plus sustainable aviation fuel. All interesting for sure. But it's that fourth one, lithium solid electrolytes for batteries, that we think could be the real game changer here. And here's why that's such a big deal. Our analysis shows that this push into solid-state batteries could literally revolutionize the company. Through their key partnership with Toyota, Idemitsu has a genuine shot at moving from just being an energy supplier to becoming a core technology holder in the entire next generation of electric vehicles. Now, a vision this big, it costs a ton of money, and it's not going to happen overnight. So the question you're probably asking is, can they actually afford it? Is their balance sheet strong enough for this kind of marathon? We ran a full financial health check to find out. Our DuPont analysis gives us a great look under the financial hood. You can see the profit margin is tight, just 1.1%, which we expected. But look at their asset turnover. It's high, which means they're super efficient with what they have. And just as important, their leverage is prudent. They aren't getting themselves into deep water with debt. But this right here is the number I really want you to focus on, 38.1%. That's their equity ratio. And what it really means is that they have a very healthy financial cushion. That's the firepower they need to fund this massive, expensive transition without taking on crazy amounts of risk. And just to be sure, we ran our bankruptcy risk model. The result? Their Altman Z-score is sitting firmly in the safe zone. So, despite all the pressure on their old business, the company's fundamental financial health is solid. They absolutely have the foundation to run this race. Okay, so let's pull all of this together. What's our final assessment? It really comes down to a balancing act. On one side, you have some profound, serious risks, but on the other, you have a truly transformative opportunity. And one of their core strengths, something you really can't overlook, is their strong ESG performance. I mean, look at these ratings. A's in social and governance. In today's market, this is huge. It helps them manage those non-financial risks, and frankly, it keeps investors confident. So this slide really is the whole story in a nutshell. The opportunity is just massive. The chance to take a commanding position in the next-gen solid-state battery market with Toyota. But the risk is also very real. They've got these underperforming overseas assets like that struggling NSRP refinery in Vietnam that could become a serious drag on their balance sheet. So the key thing to remember is that this is absolutely a marathon, not a sprint. For any investor, the single most important metric to watch is going to be the crossover point. The year that profits from these new, non-fossil fuel businesses finally out-earn the legacy business, that will be the moment we know for sure their transformation has truly succeeded.